massive new IPOs rock Shanghai, but is resistance building? A big push for private equity, and is it quantity over quality with Chinese stocks? The Shanghai Composite Index is still above 5,000 and looks to stay that way for the immediate term. The index hit a record high yesterday at 5,425.208, down slightly today. The CSI 300 index looks much the same, with a new record high September 17 at just under 5,500. B shares in Shanghai are way up for the week, but still below the level of the end May peak. Shanghai B's closed September 19 at 359.63. Shenzhen B's shares mirror this performance and closed today at 776. Overall, stock markets surged since yesterday's interest rate cuts announced by the American Federal Reserve. Helicopter Ben Bernanke will indeed drop dollars on financial markets that, in the words of economics commentator Martin Wolf, have taken the global economy hostage. But there was no yang from the Chinese central bank, but yen, as the People's Bank of China took the opposite tactic and increased both the base deposit and lending rates, the fifth rate hike so far this year, with more to come, according to Morgan Stanley's Ching Wang in Hong Kong. Chinese central bankers are still trying to cool down the economy and, most importantly, growth of China's money supply. Resistance may be building in the Shanghai markets, according to some observers. Indeed, my latest rough support and resistance chart of the Shanghai Composite Index shows lackluster potential above current levels. Remember, my call earlier this year was for the index to be around 4,600 by 2008. And new investment targets are finally on the horizon, giving cash-rich Chinese a chance at diversification. 4 new industry investment funds were approved by China State Council and plan to raise cash valued over $6 billion US. They will operate as a type of private equity fund and will support businesses in 4 key areas and locations: Shanghai for financial investments, Guangdong for atomic power, Shanxi for coal, and Sichuan for high-tech industrial manufacturers. And there is a 5th fund, a joint China-Singapore fund, also in high-tech. The Chinese corporate bond market will get a slight boost from China Yangtze Power, listed as an A share, which plans to issue 4 billion yuan worth of 10-year fixed-rate bonds starting next Monday. The blockbuster IPO of the week is China Construction Bank, raising almost $8 billion US and is now the biggest domestic IPO champ of the year. The A share stock is expected to list in Shanghai early next week and is already listed on the Hong Kong exchange as an H share. Charlotte, North Carolina-based Bank of America is a strategic investor and owns over 8% of China Construction Bank. Bank of Beijing also opened today, and its share price almost doubled. Rounding out a very busy morning in Shanghai, China Shenhua began accepting bids for its IPO. China Shenhua is the largest coal company in China, accounting for about 10% of the country's production, and the money raised could be used for acquisitions overseas. The company's chairman told the Financial Times he was interested in buying mines in Indonesia and Australia, as transportation costs to China's booming southern coastline are cheaper overseas than over land from northwestern China. This is an interesting and potentially important development affecting many areas of investment in the mid to long term. All 3 of these IPOs were mentioned in previous episodes of this broadcast. And the Boeing company has officially hitched its wagon to China, announcing with some fanfare that its gravy train focus is the 3,400 new planes Chinese airlines will need to buy over the next 20 years, valued at $340 billion US. Boeing is claiming this market as its own, despite intense competition from Airbus and China's intent to develop big-body airplanes during the same time period. Boeing shares, traded as BA on the New York Stock Exchange, were up considerably on the announcement and closed today at $100.02 a share. Earlier this week, a stock rating business called Rate Financials said the major Chinese companies listed on the New York Stock Exchange, such as PetroChina, China Mobile, China Life Insurance, and so on, which are among the top 50 most valuable companies in the world and whose stock is held by thousands, including admired investors such as Warren Buffett, have poor earnings quality and poor disclosure, and the exchange was criticized for championing Chinese IPOs. Particular emphasis was placed on the amount of shares still owned by the Chinese government. But there are numerous other big public companies that are partly or even wholly owned by foreign governments, such as France and Russia, to give only 2 examples. Rate Financial's methodology gives plus or minus scores for such things as expensing stock options, over-optimistic assumptions on future earnings, low tax rates, discontinued operations, corporate government, inventory free cash flow, and what information is shared with stockholders. But rating agencies have lost a lot of credibility in the wake of the subprime panic, and the rating and ranking of securities remains a subjective process, despite all efforts to wrap them up with technical analysis. I still believe the Chinese companies on the New York Stock Exchange are an exciting chance to ride the Chinese juggernaut. I'll see you next time.